Today we're going to talk about the trend indicators. So let's start with the moving averages, MA. Moving averages can act as dynamic support and resistance levels and are calculated by taking an average of past closing prices over a specified period of time to obtain a single line on the chart. So how do they help us? Its smoothing effect prevents short-term price fluctuations by filtering out the noise. There are two common types of moving averages, simple moving average, SMA, and exponential moving average, EMA. The main difference between the SMA and EMA is its sensitivity to price. This is because in its calculation, the EMA gives more weight to the most recent price and less weight to older prices. Hence it tracks prices closer as compared to the SMA, thereby making it more sensitive. On the other hand, the SMA gives an equal weight to all prices that it calculates. Thus, it will produce a smoother line as compared to the EMA. The diagram below shows a comparison between the 50 EMA in blue and 50 SMA in red on EURUSD. We can see that the 50 EMA in blue tracks recent prices more closely as compared to the 50 SMA in red. While there's no need to manually calculate moving averages, thanks to the indicators being widely available, it is important to understand the parameters used in the calculation to fine-tune your trading strategies in the future. As shown in the diagram below, a length of 20 means that the values are obtained from the past 20 periods of data. The most common length periods are 5, 10, 20, 30, 50, 100, and 200. The table below is a rough guide of the length of EMA or SMA to use, depending on the time frame we're trading on. Traders who are taking shorter-term trades on lower time frames would want to consider using SMAs or EMAs with a shorter length, as they are more sensitive to price changes. Conversely, traders who are taking longer-term trades on higher time frames would want to consider a longer length for their SMA or EMA. In the chart below, we can see that the 20 EMA purple line tracks prices much more closely when compared to the 50 EMA blue line. One of the most common trading strategies is the moving average crossover. The first crossover we'll explore is the price and moving average crossovers. While there are no hard and fast rules when it comes to the length or the type of moving average we have to use, we can choose the 20 EMA. In a price and moving average crossover, we can interpret it as follows. Price crosses above moving average, buy signal, and price crosses below moving average, sell signal. In this case, using the 20 EMA as an example, with reference to the chart below, we can see that after prices cross above the moving average, it tends to move higher. This shows a strong bullish momentum and could generate a buy signal for traders, as represented by the green arrows. Conversely, when prices cross below the 20 EMA, prices tend to move lower. This shows a bearish momentum, generating a sell signal, as represented by the red arrows. While this could play out nicely in a trending market, we do have to be careful of the whipsaws when prices are moving sideways. Did you notice the boxes highlighted in blue? These are what we call fake outs, which means a false signal is generated before moving in the opposite direction. For example, looking at the first blue box shown in the left of the diagram, we can see that prices cross below the moving average in gold, which would in turn generate a sell signal for us. However, that turned out to be a false signal before prices continued to push higher. Another popular strategy with moving averages would be the short-term and long-term moving average crossovers, also commonly known as the golden cross and death cross. It uses a 50-period length moving average as the short-term moving average and the 200-period length moving average as a long-term moving average. The golden cross occurs when a short-term moving average crosses above the long-term moving average, signaling that the short-term bullish momentum is stronger and prices could push higher. Hence, after spotting the golden cross, traders could consider entering a long position. Now let's look at examples of golden and death crosses in the chart. The red line represents the 200-day moving average, while the blue line represents the 50-day moving average. As we can see, the 50-day moving average, blue, tracks prices much closer as compared to the 200-day moving average, red. When the blue line crosses above the red line, it's known as a golden cross, which signals a bullish momentum where we saw prices push higher thereafter. The golden crosses are represented by the green arrows in the chart. Similarly, when the blue line crosses below the red line, that is known as a death cross, which signals a bearish momentum where we saw prices push lower thereafter. The death crosses are represented by the red arrows in the chart. If you found this video helpful, give it a like, subscribe to the channel, and turn on the bell so you don't miss the next trading tips. And if you're ready to take your trading seriously, check the link in the description.